in the stock market? It's not luck. It's not insider tips. It's discipline and a proven strategy. Benjamin Graham's legendary book, The Intelligent Investor, has guided investors for over 70 years. Even Warren Buffett, one of the richest men alive, says this book changed his financial life forever. Today, we'll dive deep into The Intelligent Investor's timeless lessons. You'll learn to protect your money, grow your wealth, and avoid mistakes that destroy fortunes. Graham defines an intelligent investor as patient and disciplined. They focus on long-term value, not short-term hype. Most people chase hot stocks or react to news headlines. Intelligent investors stay calm, buy quality assets, and let compounding work its magic. One of Graham's biggest lessons is knowing the difference between investing and speculating. Investing requires analyzing a company and understanding its true value. Speculating is blindly guessing trends and hoping for luck. Many think they're investing when they're really speculating, leading to losses. To explain market psychology, Graham uses Mr. Market. Imagine you own a business with Mr. Market as your partner. He continually offers to buy or sell shares. Sometimes he offers high prices, sometimes he offers low ones. Your job? Don't let his mood swings control you. Buy when he's pessimistic and sell when he's overly excited. This brings us to the golden rule, margin of safety. Always leave yourself a margin of safety. In simple terms, never pay full price. Buy below intrinsic value. This protects you from significant losses. Think of it like driving safely. A margin of safety is essential for smart investing. Graham divides investors into two categories. The defensive investor seeks safe, effortless growth, sticking to index funds or safe blue-chip stocks. Meanwhile, the enterprising investor is willing to do research and actively look for undervalued opportunities. Both can succeed, but it's vital to know your strategy and stick to it. Emotional discipline is crucial in the stock market. Fear and greed ruin more investors than poor businesses do. When prices rise, greed leads people to buy at the top. When prices drop, fear causes panic selling. The intelligent investor does the opposite, buys when others are fearful and sells when others are greedy. This discipline sets winners apart from losers. How do these principles apply today? During the 2008 financial crisis, fearful investors sold. Intelligent investors bought quality companies at bargain prices, and their investments multiplied in 10 years. Graham's advice holds true even today: don't panic, don't chase trends, and always prioritize a margin of safety. Warren Buffett, who read The Intelligent Investor at 19, considers it the best investing book ever. He states that successful investing requires a sound intellectual framework. This framework and emotional control is what Benjamin Graham provides. So, what can we take away from The Intelligent Investor? Don't speculate, invest with discipline. Treat market mood swings as opportunities, not threats. Always require a margin of safety. Decide whether you're a defensive or enterprising investor and commit to your strategy. Most importantly, control your emotions. Patience and discipline build real wealth. If you want to protect your money and invest wisely, read this book. I've added the link to The Intelligent Investor in the description. Click it, grab your copy, and start your smarter investing journey today.